Friday, November 16th. We have change, and I'm early with this. Maybe some of it's wishful thinking, but there's a change in the data pattern, and the charts and gory technical details are in the newsletter beside this video. But there are cycle turning signs in the economy. Housing's part of it, although this housing cycle is anomalous. It's the only housing cycle on record which does not have an overbuild of new construction and also does not have a proliferation of credit that's too easy, which should keep housing from pulling down on the rest of the economy the way that it has in other cycles, but there are other things that are rolling over. Auto sales are in the process of rolling over because interest rates are up. One of the ways that the Fed bites into the economy is just plain interest rates. And even car leasing is an interest rate deal. And forecasting a turn like this is impossible because there are so many forces that play on the economy, and many of them are lagged. The first to slow down are the interest rate sensitive ones, housing and cars. The last is jobs. The primary motivation for the Fed to do this rate hiking deal is because we're creating too many jobs too fast and there's an inflation risk. But historically, we continue to create new jobs in volume even after the recession has technically begun. The monetary policy, the Fed has been raising the overnight cost of money for 3 years. It started in December 2015. That's a long time. We know that monetary policy operates with a lag of somewhere between 6 and 18 months, which is hardly precise. But we think we know that a given degree of Fed rate hiking takes a year or more to actually have its impact on the economy. Now, the Fed has been raising the cost of money a quarter point every 90 days in the last 18 months. That overnight cost of money is now 2 1/4. The Fed meets on the 19th of December and everyone expects them to go to 2 1/2. That takes the prime rate to 5 1/2, which is a shock to a lot of people with home equity lines of credit. All adjustable rate mortgages, the new payment change notice going out is to roughly 5 1/4. And these are loans which should have begun to adjust 7, 8, 9 years ago, and people have simply forgotten that they're on adjustables. Those calls are coming in. The marketplace has changed. The 10-year Treasury note is what drives mortgages. And the 10-year T-note in a little more than a week has come down from 3.23 to today 3.07. If we crack 3.06, mortgage rates are going to come back down below 5. We'll take it. The 2-year T-note is the one that tells us what the Fed is up to. The Fed raises or lowers the cost of money overnight. A 2-year T-note is very short term, has to be priced relative to the Fed, and it fell to a 2 1/2, 3-month low. Also just in the last week, the vice chair of the Fed, Richard Clarida, was on CNBC this morning with, let's just say, soft things to say. When the vice chair turns up on CNBC with soft things to say, he's speaking for the Fed. He's not speaking for himself. He's trying to signal the marketplace. Now, the good news, bad news deal is we get lower interest rates if the economy softens. Here's the glimmer of hope. Housing markets, urban housing markets especially, and suburban, have been on fire now for about 6 years, since the very beginning of 2013, 5 years. These urban centers are the centers of employment. They're the highest wages in the economy. There are all these hordes of technology people who understand electrons. There's a chance that that prices largely stop rising. They should. Prices have risen in the last 5 years at twice the rate that incomes have grown. So if prices stop rising, the hope is that that creates more inventory, that more stuff comes on the market than goes off for the first time in years, and it's already happening in several markets around the country. And perversely, we could wind up with flat prices, but more properties to sell, and so actually the number of sales goes up. That would be Merry Christmas for a lot of real estate brokers and mortgage lenders. And on that thought, have a happy Thanksgiving.